All right, you guys ready? How you doing? Is everything going okay? Get the homework in all right on Tuesday? I have to get through those still. I will make sure I get those done today or tomorrow. But any questions before we get going? Finish up chapter 4 today. Do some problems. We might get up a little early, but no guarantees. I don't think we have as much to go over this class as we did last class. Nothing before we get going? All right. And it's good, like the semester is going fast. This is chapter 4. We have one more chapter next week, and then the week after we get our first test on the 10th. So we'll have a day to review and everything too. So hopefully you guys will be totally prepared. A lot of the problems we do in class are going to be like exam problems, so hopefully that's helpful. I don't know. But, all right. So chapter 4, we talked about this income statement and related information. Last class, we talked about these first 3, income statement, format of the income statement, and then irregular items. And we did a bunch of problems. And in this class, we'll talk about these other reporting issues and do some problems related to that. So that's the plan. Got through irregular items. These are the 3 we talked about: unusual gains and losses, discontinued operations, and non-controlling interest. And we'll do some problems related to this stuff. All right, so other reporting issues. You have the multi-step. Just to recap everything we did last class, we had the multi-step, single-step income statements, and the multi-step income statement. We start with we classify things by whether they're related to the operations of the company, main operations or non-operating activities, and then we have discontinued operations. Those get reported below because they really aren't recurring. So when we think about the multi-step income statement, we want to put the most recurring items at the top, the things that you expect to go on in the future, the most important things to analysts, to investors. They want to forecast that kind of stuff that's going to recur. And they probably don't want to forecast the stuff that's a one-time item. So, that was sort of our initial look at this multi-step income statement. Then we talked about discontinued operations and a few unusual items. One of the other things that is on the income statement is earnings per share, so per share numbers. So first we'll start with that. Earnings per share, we talked about this. There's a couple ways of calculating it, and when you get to intermediate 2, you'll get more in depth with earnings per share calculations. The one that's required, there's 2 that are required: basic earnings per share, which we'll talk about in this class. This is basic earnings per share. It's the earnings that are you're buying when you buy 1 share of common stock. So as a common shareholder, you want to know not only that the company is profitable, but that your 1 share of the company is worth something, right? So the denominator is really important. It's the number of shares outstanding. So if you buy a share of stock, how much of that net income are you actually buying? Because you want to forecast the price of that share of stock. Okay, so earnings per share. We subtract off, in basic earnings per share, we subtract off preferred dividends, because these are dividends that would be paid out to someone ahead of you, right, as a shareholder, as a common shareholder. So there are preferred shareholders out there. It's an alternative form of stock. So, what you buy, typically you buy, if you go to the New York Stock Exchange or, you're just trying to buy a share of stock, is a common share of stock. That's the most, it's the one that's kind of available to anybody. But there are these preferred shares that sometimes companies give out to special groups, like, for example, employees, or if the owner or something wants to have some additional preference over some aspect of ownership, then they'll get a preferred share, which has some preference. One of the most common types of preferred shares provides dividends ahead of common shareholders. So they'll be like a dividend percentage written on the preferred share of stock. And as a preferred shareholder, you're entitled to that percentage dividend every year, percentage of the par value of that stock. So if you're thinking about this from the perspective of the common shareholder, you want to subtract off these preferred dividends that are going to get paid out before you'd have any right to net income. Right? Does that make sense? So just to come back full circle, right? Net income is the money that the company generates, the amount of value the company generates, and the owners own that net income, right? And they get paid out that net income through dividends. But if some of it's going to get paid out to somebody else before you want to subtract that off. So that's why we subtract off preferred dividends. So net income minus preferred dividends divided by the weighted average shares of common shares, weighted average common shares outstanding, should give you your earnings per share number. Is that okay with everybody? Has everybody seen earnings per share before? Okay. So this is kind of what analysts forecast. It's what you want to use to value the stock. A lot of times people will use it as a comparison to compare a PE ratio, price divided by earnings per share. That's why sometimes they use that to determine if the stock is overvalued or undervalued. So here's Lancer. They have net income of $350,000. They pay preferred dividends of $50,000. And the weighted average number of shares outstanding is 100,000. Another thing to note about earnings per share, you use the weighted average shares outstanding. So what that is a company could issue additional shares in the middle of the year, and that's going to change the number of shares outstanding. What we would do, and I'm not going to have you guys do it for this test, what we would do is try to calculate the weighted average of the number of shares outstanding throughout the entire year. So for 3 months, there were 100,000 shares outstanding. 3/12 of the weighted average shares outstanding would be 100,000 shares. And then if for the remaining 9 months, there's 200,000 shares outstanding, 9/12 of the year would be 200,000 shares. So you get something in the middle between 200 and 100,000 shares outstanding. But I'll give you the weighted average shares outstanding. And with that, you should just have these three. You should just be able to remember this equation: net income minus preferred dividends over weighted average shares outstanding, weighted average common shares outstanding. So you get $3 per share. So earnings per share is always reported down here. I didn't update this one. Down here at the bottom of the income statement. And we report earnings per share for continuing operations, discontinued operations, and net income. So all those final summary figures get per share treatment. So that's earnings per share, our basic overview of that, quick overview. Gets a lot more complicated when you do diluted earnings per share, which I'll do in intermediate 2. All right, so accounting changes and errors. So we might have changes or problems that happen where things could change, right? We could have a mistake that we had in prior periods. We could have a change in estimate where we look at our estimates, we think they're wrong. We could change the way we account for things. So these things all have different treatment. With a change in accounting principle and with a correction of error, we're going to adjust our beginning retained earnings balance. So if you remember retained earnings, the statement of retained earnings, we have beginning, and we have something like So the statement of retained earnings, a lot of times it looks like this. You have your retained earnings at the beginning of the year, plus net income minus dividends gives you retained earnings at the end of the year. When you have a change in accounting principle or a correction of errors, you're going to include something here, a prior period adjustment. To correct for the change in accounting principles in the prior years. We're going to recast prior years as if we changed our accounting principle. We used the current accounting principle in prior years. Or we're going to correct the errors in prior years. We're going to have a prior period adjustment here. So I'll go through this. The alternative is this change in estimates where it's just a prospective. There's no retrospective adjustment. There's nothing like this. All we're going to do is just change the accounts going forward. So I'll show you how that goes through these slides. So the change in accounting principle, we have this retrospective adjustment where we make a prior period adjustment to the statement of retained earnings. The cumulative effect of the adjustment affects retained earnings. We have comparability. So if I switch from FIFO, I don't know if you guys remember cost flow assumptions, FIFO average cost, LIFO FIFO average cost. If I switch from FIFO to average cost, it's just a way that we attribute costs in our inventory to cost of goods sold. If I change from FIFO to average cost, it would have an effect in this year, but it wouldn't be comparable to last year because I used FIFO last year. Right? If I average cost this year and FIFO last year, this year's cost of goods sold wouldn't be comparable last year. So we have to make this adjustment to last year's retained earnings, to the beginning retained earnings, and to that adjustment is based on sort of an analysis of how using FIFO in previous years would have affected our net income. So that's the idea here with the change in accounting principle. We want to make everything comparable, so we have to make this prior period adjustment to retained earnings. With a change in estimate, this is like if I have depreciation. I have an estimate of the useful life of my long-lived asset. I have an estimate of the salvage value. If those change over time, it's not the end of the world. I can update my estimates. And when I do that, I'm just going to make an adjustment this year and in the future. So I'll show you an example. We're not going to do anything like this where we have a prior period adjustment. I think I'll probably go through this in the slides. But here's Arcadia High School. They purchased equipment for $510,000. They thought it had a useful life of 10 years and salvage value of $10,000. They record depreciation for 7 years on a straight line basis. And then in 2015, it's determined that the total estimated life should be 15 years with a salvage value of $5,000 at the end of that time. So if that is the case, they make this change in estimate in 2015, then we're not going to make a journal entry to correct prior year's depreciation. We're just going to correct this year and going forward for this change in estimate. So the first thing we do is calculate depreciation up to the change in estimate. So in this case, they said $510,000 for equipment, $10,000 salvage value. So $500,000 is what we're going to depreciate over a useful life of 10 years. And we're going to depreciate it for 7 years. You see our $500,000, the useful life. So we're trying to come up with what the book value of this asset was when the change of estimate occurred. And that ends up being $160,000. So the cost minus the accumulated depreciation is the book value. $160,000. So we'll take that $160,000. Now this year we have this change in estimate. I'm going to take what's remaining in the book value of the net book value remaining, $160,000, and I'm going to depreciate that down to zero using my new estimates. So now I think that the salvage value is $5,000, and there's still 8 more years left in its useful life. So I can subtract off the $5,000 from the net book value, give you $155,000 to depreciate over 8 years, and then I can calculate depreciation again. Is that okay? So change in estimate handled in the current period and going forward. The other two are handled as a prior period adjustment. You're not going to have to calculate the prior period adjustment. I'll always give you the prior period adjustment. Okay? All right, so correction of errors. Handled a lot like a change in accounting principle. We're going to have a prior period adjustment here in the statement of retained earnings. This is like the bad one. This is like, somebody's getting fired because they made a mistake, and it was a material mistake. We have to have a restatement. So if you ever hear the word restatement, that's an error that has to be corrected in prior years because it changes investors. It's material, right? It changes investors' view of a company. So that's a big error. If they have to correct it and make a prior period adjustment. So when I was working as an auditor, we had one of these at General Electric, and that was like a huge problem. All the auditors have to stay and audit the restatement, and it's incredibly expensive for a company to do this. Just like recasting, you have to resubmit all your financial statements from prior years after making corrections. Not great. Not a good thing. So those are the three things, kind changes and errors. So make sure at least you have an idea about how these are all handled and what we do with the financial statements. So there's some problems on this too. Comprehensive income is the other big concept we talk about in this at the end of this chapter. So the question is, what do we want in the income statement? Kind of two differing opinions at the FASB. One is that you need to have everything, the all-inclusive concept, that every change in net book value, so assets minus liabilities, every change in equity should be recorded in the income statement, where those came from. That's this all-inclusive concept. Some people argue that all that should be on the income statement because that's what the income statement is supposed to do. It's supposed to show you how you got from last year to this year. Other people say the income statement is supposed to represent performance, so net income. Everybody thinks of that as a performance measure. So what the FASB did was try to balance this. Well, so there's lots of things that in this all-inclusive concept that don't really represent performance. So, how do we balance these two differing opinions? There's a modified, so the way the income statement is actually produced is it's sort of like a modified all-inclusive concept. We have, the FASB allows a few items to bypass the income statement and be recorded in a separate thing called other comprehensive income. All right? So it's not really, it doesn't go into net income. It's just a few other things that don't really represent performance that are recorded in this statement. They're included in comprehensive income, which really represents, kind of follows that all-inclusive concept. So these are the four things. I'm not going to quiz you on each of these things. Foreign currency translation. If I'm in the United States, I have operations in Brazil, and Brazil's currency is worth something different than it was in dollars at the end of the year than it was at the beginning of the year. Is this either a gain or loss on owning Brazilian reals or whatever they're called? I think they're reals. That kind of stuff has no bearing on the performance of the company, really. But it does affect net assets from last year to this year. So that stuff the FASB allows you to report as this other comprehensive income item. Accounting for futures contracts, I'm not going to get too much detail about derivatives, but a futures contract is a purchase of some inventory in the future that you're paying for now, and that could fluctuate, but you might not use the futures. So anyway, that might not represent performance if you never are going to exercise that contract. And pensions, right? Pensions. Companies have huge pension liabilities. If you think about, for a lot of the automotive companies had a lot of pension problems around the financial crisis. Right before that, we had all that went through. But yeah, pensions are another thing where it's not really affecting your performance day to day. It's just holding cash so that you can pay people out when they retire. That's not really related to today's performance. And then finally, this one, the only one we're going to cover in this class, is accounting for certain investments in debt and equity securities. So some investments are held at fair value. The fair value fluctuates up and down. That doesn't necessarily predict the value of what you're going to sell the investment at. So the FASB allows you to put that in this other comprehensive income section. So too much detail about that. But those are the things, be aware of them. It's weird stuff that doesn't represent performance. That's what you got to know. And one thing I'll put on here is unrealized gains and losses on available for sale securities. So since we're going to cover investments in this class, that's the one you'll see, and you'll just know that one is related to other comprehensive income. It's not related to income. It's going to be recorded in comprehensive income, other comprehensive income. All right? Okay. Gains and losses that bypass net income but affect stockholders' equity are referred to as comprehensive income, non-comprehensive income, other comprehensive income, prior period income, unusual gains and losses. B, other comprehensive income. Yeah, right. So, I know maybe this was confusing, but this is kind of, let me just do this too, because I'll try to make this a little more clear. And we'll talk about this in more detail as we go through the class. So, you can have comprehensive. So there's ways of this. There's three approaches to reporting comprehensive income. You can have a separate statement where you have net income. This is your income statement for Verizon. And then you have a separate statement of comprehensive income where you start with net income and then you show these other items, like these other unrealized gains and losses on marketable securities, pension stuff, foreign currency adjustments, and then you get to comprehensive income. So this other comprehensive income is the new stuff that we add to net income, and then we get to comprehensive income. So net income plus other comprehensive income equals comprehensive income. So this is sort of the separate way. You can also combine the income statement and the comprehensive income in the statement of comprehensive income. Or you can have a statement of stockholders' equity, which I'll show you in just a second. So this is this C. Reader company. They have sales, cost of goods sold, operating expense. They have net income of $120,000. And then they look at their stockholders' equity accounts. They have common stock of $350,000. Other comprehensive income of accumulated. So that's the other thing about this. This other comprehensive income accumulates just like retained earnings in an account called accumulated other comprehensive income. So we close net income out to retained earnings. This other comprehensive income stuff gets closed out to accumulated other comprehensive income. So accumulated comprehensive income, and then retained earnings of $90,000. It issues no stock during 2018. So how do we prepare a statement of stockholders' equity? Well, a statement of stockholders' equity is going to have all of your equity accounts listed across the top. So retained earnings, accumulated comprehensive income, common stock, and then we're going to look at changes in those accounts. So we have a beginning balance, and then net income. Net income is going to increase retained earnings, right? Because it's going to get closed out to retained earnings. And then this is the total, right? So we're just adding across. We have an unrealized holding gain or loss. We have an unrealized holding loss. So that was the one I was going to ask you to remember from other comprehensive income. That would be dumped in accumulated other comprehensive income. You sum that across. And then if we issue dividends, that's going to reduce retained earnings. And then you can sum it across. So in this way, you can kind of see the ending balance. You can see how every account changed throughout the year. Is that all right? So that's a statement of stockholders' equity. That's an alternative to putting together statement of comprehensive income. So that's really, all that's left in this chapter. Do you guys have any questions about this stuff? IFRS is slightly different. You guys can look at this. A little stricter on discontinued operations. Is this exciting? Had no idea there was comprehensive income. Or have you guys seen comprehensive income before? No, okay. Like I said, don't get too intimidated by it. It's just a few weird things that don't represent performance, and so they get relegated to this other comprehensive income section. It's actually kind of interesting how this happened too. Part of the unrealized holding gains and losses on investments. So when the FASB moved from historical cost to fair value, a lot of banks didn't want fair value on their balance sheet because fluctuating investment prices make banks look more risky. So if you looked at a bank's financial statements and they fluctuate a whole lot, they went, one year they're really high and the next they're down, and they fluctuate with the market. That would be a big problem, especially if you have an economic downturn where the stock market drops, and then you want banks to lend money to people, but their balance sheet looks terrible because the stock market's down, and they have to record everything at fair value, so it's going to destroy their net income, and they look really instability and unstable. So that is a problem, right? That's a big problem. That's part of the reason why during the financial crisis, people blamed a lot of it on banks because, they said, blamed a lot of the financial crisis on fair value accounting because they said banks couldn't lend because they didn't have they looked really bad, right? So anyway, but when the FASB went to fair value accounting, one of the things they did was they moved these unrealized holding gains and losses on fair value on investments to other comprehensive income, so it didn't make banks' net income look so bad. It didn't make their net income look like it fluctuates a whole lot. Fun facts all over the place. I don't know if that's a fun fact. Fact. All right, let's do problems. Which of the following is not a generally practiced method of presenting the income statement, including prior period adjustments in determining net income, the single-step income statement, the consolidated statement of income, including gains and losses from discontinued operations, of a component of a business in determining income? Yes, thank you. Which one not a generally practiced method? Yeah. Single step, yeah, there are some single step income statements out there.
I thought because it wasn't a method, like a generally practiced. I don't know. Yeah.
Just yeah, it's kind of, I guess it's
It's more like a type of
type. But I think there's one that's clearly not something we want to do. Yeah. D, including gains. So no, we still include them. They still get a net income. But they're below that tax line, but it still goes into net income. Any other? There's two left. There's two left. Chances are getting better. Yeah. Yeah.
Including prior period adjustments and determining net.
That's right. Yep. So prior period adjustments go into retained earnings. It's a prior period adjustment to retained earnings rather than an adjustment to net income. And again, net income, right? It's supposed to capture this year's performance, not prior year's performance. Where must earnings per share be disclosed in the financial statements to satisfy generally accepted accounting principles? On the face of the statement of retained earnings or statement of stockholders' equity, in the footnotes to the financial statements, on the face of the income statement, or on the face of the balance sheet. Where do we put earnings per share numbers? Yeah.
C.
Yep, face of the income statement. That's where it's got to be. So they're right there below net income. We have per share amounts. A correction of an error in prior period's income will be reported in the income statement or net of tax. So you got lots of different yeses and nos there. So if I have a prior period adjustment, I guess I didn't even say this in class today, but making sure you guys paying attention. Yeah.
D.
Right. Yeah. It's in the income statement, or no, it's not in the income statement. Or where is it? It's in the statement of retained earnings. So not in the income statement, and it is net of tax. So we always have to make the adjustment net of tax because retained earnings is all net of tax, right? And if I'm going to adjust retained earnings, I have to make an adjustment that's net after tax. Awesome. The change in accounting principle requires that the cumulative effect of the change for prior periods be shown as an adjustment. So if I have a change in accounting principle, right, it's like LIFO to FIFO or something like that. I'm going to have a change to prior periods. It's going to be shown as adjustment to beginning retained earnings of the earliest period presented, net income of the period in which the change occurred, comprehensive income for the earliest period presented, or stockholders' equity of the period in which the change occurred. The cumulative effects of that change in accounting principle effects. Yeah, sorry.
A.
Hey, yep, beginning retained earnings, right? So that was like we had up here, we had beginning retained earnings, then we have a prior period adjustment, plus net income minus dividends equals our ending retained earnings. So we wouldn't want to do net income, comprehensive income, right? That doesn't matter. It's going to affect, so I guess the only one that could have had like questions about is D, stockholders' equity in the period in which the change occurred. It's going to affect that eventually, but the way we're going to present it is in the statement of retained earnings. All right, so which of the following items would be reported net of tax on the face of the income statement? So on the face of the income statement and net of tax. Prior period adjustments, unusual gains, changes in estimates related to allowances for doubtful accounts, or discontinued operations. Anybody else want to take a stab here? Yeah.
Discontinued operations.
That's right, yeah. Discontinued operations. So yeah, discontinued operations is going to be in the face of the financial statements, right? That's that section below income tax. So it has to be net of tax as well. Prior period adjustments are net of tax, but they're adjustment to beginning retained earnings in the statement of retained earnings. Unusual gains are pre-tax above the income statement line. That's in that other income or loss section. And then changes in estimates, right? That's just going to adjust the way you make a current adjustment, how you're taking depreciation, or how you're recording bad debts. In this case, you don't make a retrospective adjustment. All right, Palomo Corp has a tax rate of 20% and income before non-operating items of $1.785 million. It also has the following items. Gross, they're not net of anything. Unusual gain, loss from discontinued operations, dividend revenue, and then income increasing, prior period adjustment. What is the amount of income tax expense on the income statement? So this one I'll take a little math. So I'll give you guys a second or two. Try that out. So this is the income before non-operating items, or we call that operating income from operations, or operating profit. All different words for the same thing. Anybody? Yeah.
Is it C?
Oh, not quite. Let's see. Thanks for asking. Thanks for participating in our teaching. Yeah.
Is it A?
It's A. Yeah. How did you get to A?
So the operating income before non-operating items
Right.
plus the dividend revenue and then plus the unusual gain.
Yep. So this was 90 or 30 and 115. So that gets us to like 8, 9. Is that what you got?
Yeah, and then multiply by 20%.
Yep. So pre-tax, before tax, income from continuing operations before taxes, 1,930,000. So income tax. Would be this amount times 30%. Right? Did they say 30? 20%. It's 386. Cool. And then you can complete this too, right? If you wanted to put the, I guess there's discontinued operations. You could put that, this is going to be income from continuing operations down here, and then you could do discontinued operations, and then discontinued operations would be after tax, and then you could get the net income if you wanted to complete the income statement here, right? I'm not going to do it because all right, earnings per share. We have Benedict Corporation. They have net income of $750,000. Dividends on common stock, dividends on preferred stock, and they have weighted average common shares outstanding. What is their earnings per share? If you know the formula, you should be okay doing this. This shouldn't be hard. Yeah. C. 2.64. Yep. So what's that? Just.
Net income minus preferred stock.
Yep.
Divided by the weighted average.
Right, 750 minus 90 over 250. That should get you to this 2.64. Is that okay? So really, don't worry so much about earnings per share stuff, because this is probably, maybe I'll give you, we'll go through the problem. We have one more problem. Here you go. I'll hand this out. This is from your homework, so we're knocking some homework out here. There was a typo in the homework, believe it or not. This problem, they updated it with the new version of the book, but they also made a typo when they updated it. So it says that, you guys notice that? Well, all right, so I think the one in your homework, it says that net income is $202 million. That's just total equity. Net income is $33 million in your homework. I used the updated version in your homework, but it's the same as this, but they just changed the years. This is from the previous version of the book. I'll send a note about it so you guys. But it's the same problem. So, all right. So this is earnings per share. We have information from the stockholders' equity section of Hendley Corporation at the end of the year. Net income, they say, is $33 million. That's what it should be in your problem in the homework sheet. It reflects a total effective tax rate of 34%. Included in the net income figure is a loss of $18 million before tax as a result of a non-recurring major casualty. Preferred stock dividends of $360,000 were declared and paid in 2017. Dividends of $1 million are declared and paid to common stockholders in 2017. Compute earnings per share as it should appear on the income statement of Hensley Corporation. So remember what the, they give you some. You might get this, and you're gonna have to deal with this kind of stuff when you're in the business world. You're gonna have information that's unnecessary. So some of this information is unnecessary. Just so you know that. But just remember the calculation for basic earnings per share. I think there's another hard part about this one, and it gives us an opportunity to talk about the types of shares that a company can hold. Shares outstanding. They tell you shares authorized and issued. I don't know if anybody knows the answer to this. I guess they only give you one amount of shares, so that's got to be the number you use. Let me know if you want to take it. If you think you have the answer, just raise your hand. Let me know. Yeah.
I got 3.26 for
3.26. That sounds. Yeah, 3.26. Yep. So what do you use? So net income, right? That's just given to you, 33 million. And then preferred dividends, also given, right? They say preferred stock dividends are 360,000. What about the weighted average shares outstanding? Would you?
Oh, I just assumed
It's 10 million.
Yeah.
Yeah. Yep. That's all you can use. That's all we have, right? But just to explain the difference between authorized, issued, and outstanding shares. Authorized shares are when a company is formed. They have a corporate charter which explains what the company is there for. Under the corporate charter, you're authorized to issue a certain amount of shares. So that's just like the business plan. You're only authorized to issue a certain amount of shares. As part of the corporate charter, shareholders can get together and change this corporate charter so that you can issue more shares. But it's an agreement among the owners to say you can only issue this many shares because the owners don't want their ownership diluted. Anyway, so that's what they're authorized. The total maximum amount of shares they could possibly issue is the authorized shares. The issued shares are the number of shares they actually issue that they sell. So number of issued shares is the amount of shares that the company is going to sell to investors, potential investors. Right? So when they have an initial public offering or a secondary offering, their shares that they're selling to the public, that's the number that are issued. Outstanding shares are the number that are issued minus treasury shares. So treasury shares are the number, if you're a company, you can go out and buy your own shares. You might want to buy your own shares there's some reasons why companies buy their own shares. They're called share repurchases. They're in the news a lot. It's one way of companies giving money back to shareholders by buying their own shares. It also, sometimes companies aim for a certain dollar of earnings per share, a dollar price number that's not too big so that everybody can buy their stock. For a while, like Berkshire Hathaway had a gigantic, it was like $5,000 for a share of Berkshire Hathaway. They might go out and buy some of their shares back, or they actually probably issue more shares. But it's about manipulating like the size of that number. I should have given an example of a company with a really small amount of shares. But you might want to manipulate the amount of shares out there so that the stock price meets whatever target. It sort of, is it the right kind of number? It's kind of weird. I don't know. There are some psychological things that go on that companies try to do. Anyway, so those are called treasury shares. If a company goes out and buys their own shares from the market, so the number outstanding are the number that are trading in the market. That's the idea. So authorized is the number that the maximum amount of shares that a company can issue. Issued is the number that they've sold to people in the market. Outstanding are the number that are trading in the market among investors. And so we want outstanding because those are the ones that represent ownership. All right, so that's the number. In this case, we have authorized and issued. They don't have any treasury shares, so the issued number is the same as the outstanding number. So here's Mormon Corporation, and they report. Do you guys have any questions about that? Sorry, I know it's like. I think there's a section about it in your book too, so you can look at that a little more about issued, authorized, and outstanding. That's always reported in the financial statements. Always reported on the balance sheet, and it's important because when you buy a share of stock, you want to know what portion of the company you're buying with that share of stock. So you need to know how many shares there are out there. Yeah.
So issued and authorized is the same thing as outstanding?
Issued is the total. So issued could be the same as outstanding if the company. It is the same as outstanding if the company doesn't hold any treasury stock, which is they hold their own stock. It's called treasury stock. Authorized is usually higher than the number issued. Could be higher. It's how many they're authorized to issue. If they want to issue more shares, they can, up to the authorized number. Does that make sense? Okay, so issued are the number that they've sold. Authorized means that that's the number they can sell. Mormon Corporation, but the one that's important for EPS is outstanding, the number that are trading at. Mormon Corporation reports the following information: correction of understatement of depreciation expense in prior years, so they have a prior period adjustment, net tax, dividends declared, net income, and retained earnings. What's their retained earnings at the end of the year? So this is that statement of retained earnings. Yeah. Let's see. Oh, it's B. Did I get B? You get B? Still get B? I guess it's B. So we start with our beginning retained earnings of $6 million. What do we add to it? Or what do we first, we have a prior period adjustment, right? We have to make that. That's the tricky part. So I think that's why C is kind of looks like a good answer, because that's going one way. It should go the other way. So the prior period adjustment was an understatement, correctly for an understatement of depreciation expense. So that means we're adding more expense. Does that make sense? So we have to subtract that from beginning retained earnings. Is that okay? So I'll just call it prior period adjustment. And then we're going to do plus retained earnings, or plus net income. Minus dividends. And now we have retained earnings of $3 million. Minus dividends. And that should be 6, 750. Is that okay? So, yeah, make sure you read carefully with these, just in case it's like understatement of retained of depreciation expense would be subtracted because we're correcting an understatement. All right, we'll do this one. And then there's a big long one at the end here. But I think I might save that. We'll just do this. We can kind of start the next one. Kind of added that at the end. All right, so January 1, 2016, Bakersfield bought a building that cost $85,000, had an estimated useful life of 10 years, and a salvage value of $5,000. They used the straight line depreciation method to depreciate the building. In 2020, it's estimated that the remaining useful life was 8 years, and the salvage value was 0. So the first question is, do we need to make an adjustment to beginning retained earnings? What do you guys think? This one's just a yes or no. You don't have to calculate it yet. Yes or no? Do we have to adjust retained earnings when we have a change in estimate? No, right? This is a no. So, yeah, it's a change in estimate here. the two that we have to adjust beginning retained earnings for are a correction of an error or a change in accounting principle. Then we make the prior period adjustment like we did in the last problem. But for a change in estimate, we make a adjust it in the current period and going forward. So then what do we record as depreciation expense in 2020, given that this situation? So there's two steps, right? The first step is to figure out what the net book value of this building was going into this year. And then we need to calculate the depreciation expense for this year. You guys doing okay here? Seems like we're kind of stunned here a little bit. Long week. It's been a long week. It's been a long January, right? So straight line depreciation, you guys remember? Straight line depreciation is cost minus salvage value or estimated useful life. So what do they do for the first, so 2016, 2017, 2018, 2019, for the first 4 years? How much depreciation do they take? 8,000? And that is 85,000 over minus 5,000 over 10 years, useful life. So we take $8,000 of depreciation times 4 years, $32,000 of depreciation. Is that okay? So then, so 85,000. So the net book value is how much? 53,000? So now we have $53,000 left to depreciate when we change our estimate. Is that okay? $53,000. So now we're going to take the $53,000 then we're going to subtract off the new salvage value. Well, we decided in 2020 that the salvage value was 0 and the useful life, the remaining useful life is 8 years. So this should get our 2020 depreciation, whatever that number is. $53 divided by 8. Yeah. 6,625. Okay. So that's kind of what I was asking. I don't think I have the answer either. All right, so take a look at this stuff. Do you have any questions so far? Okay. So yeah, I guess the thing to know here is that we want to get the net book value, get the carrying value, the value at the year when we have a change in estimate, and then we're going to apply the new estimates to in the current year and going forward. So then, we know we have this $53,000 we have to depreciate over the next 8 years. If you take $6,625 of depreciation every year, you should get to zero at the end of the 8-year remaining life. All right, so here's the other one. Why don't you guys take like 5 minutes? It's on the back side of the sheet of paper I gave to you, and see what you can do. So this is a problem, and yet obviously you guys can work together, work with people around you too. Maher Company, and they have income from continuing operations of $790,000 before taxes, and they forgot 6 things. So they're going to try to account for these 6 new things, and then they're going to prepare a income statement starting with income from continuing operations before taxes, after correcting for all these 6 items, and then you want to have earnings per share on there too. So we're probably not going to get to the earnings per share part of this problem, but do your best to try to correct for these 6 items. Try to correct the earnings, income from continuing operations before taxes for these 6 items. Give you guys 5 minutes to kind of work on that, see how far you can get, and then I have it in a spreadsheet form, so you can look at it here, and then I'll make sure I post it too. we only have a couple minutes, so we probably should take a look at it. So you start with this number, $790,000. Hopefully we're able to kind of get a few of these things. We might, just talk about it again next class. That might be it. Probably gonna have to, right? So one of the things we have is an uninsured flood loss. So this flood loss is a loss. So it's going to have to be reduced, right, from that initial number. I think that's pretty straightforward. The next thing is a depreciation error. They depreciated it as though it didn't have any salvage value. So they depreciated 54,000 divided by 6. So they recorded $9,000 of depreciation. What they should have done is recorded $7,500 of depreciation. So they recorded too much depreciation. So we need to add back the amount that they didn't record, right? $1,500. They had a loss on sales of securities. So that needs to be recorded. Right? They sold some securities and lost $57,000. And then they had the president die. It's crazy that companies can take out life insurance policies on their employees or on the president. It's like that's a kind of a weird incentive, right? But the president dies and they get a life insurance policy that pays them $150,000. That life insurance policy was already on their books as an investment, worth $46,000. So like gambling on whether or not the president's going to die. That's kind of weird. Anyway, but they end up making some money on it. So good job, I guess. $104,000 is how much they gained. So all those things added on.